Well, of course, one of the trending topics on Property Tribes is indeed limited company finance. Should I get a mortgage through a limited company or SPV? And joining me to discuss that is Ray Boulger of our finance partner, John Charcol. And Ray, in recent times, clearly since the introduction of Section 24, when it became known about in 2015, the whole sort of landscape of limited company mortgages has changed, hasn't it?
Very much so. It used to be a pretty small percentage of the market, relatively few lenders in it, and the lack of competition meant that you would pay a higher interest rate. As it's become more viable for more landlords, we've seen more lenders come into that market, and now most of the lenders who offer mortgages to limited companies, which is still the minority, but a growing minority, do charge the same rate for limited company mortgages as for mortgages in a personal name. So the premium you've got to pay to get a mortgage in a limited company has come down. Having said that, you will probably still pay more because some of the lenders with the cheapest rates still don't offer mortgages to limited companies. But there are significant other advantages to buying through a limited company, apart from the obvious tax advantage, which is the reason why most people will start looking at it. From a mortgage perspective, because the tax charge is based on the profit and it will be based on corporation tax rates, when lenders assess affordability, they haven't got to factor in so much tax for the landlord paying. That means they can lend more. So if we go back a couple of years, the general rule was that lenders would look for rental cover of 125% and do their calculation that way. Now most lenders for mortgages in a personal name are using 145%, although there is a bit of variation on that. But with limited company mortgages, a lot of lenders are using 125% again. So from a mortgage perspective, if you're buying through a limited company, you will be able to borrow more money. Combine that with the fact that if you take a 5-year fix, then you can often get a larger loan as well. So for somebody looking to maximise their borrowing and gear up as much as possible, and I'm not suggesting people should do that, but if people do want to do that, and for some people it will be right, for others it won't, then the way you would normally be able to do that is buy the property through a limited company and perhaps get a 5-year fix. Now that's fine if you're buying a property, but it's normally not going to be worthwhile switching a property you already own into a limited company because you're then going to incur 3% stamp duty surcharge, normal stamp duty, probably capital gains tax. So you'll end up actually paying too much to do the conversion. The one exception perhaps might be if you bought a property in somewhere like Northern Ireland 10 years ago and you're sitting on a loss, in which case capitalising the loss may be worthwhile. But for most landlords, that's probably not going to be worthwhile doing.
That's very, very interesting insights there. I think also for landlords, they need to understand that the underwriting criteria is a little bit different, might take a little bit longer perhaps. We've heard some lenders asking for personal guarantees, those kind of things. So it's a slightly more complex process to get a limited company mortgage, isn't it?
That's absolutely true. Nearly every lender will want a personal guarantee. You know, if you're not prepared to give a personal guarantee, then perhaps you should be asking yourself, should I really be asking for a mortgage? Because if you're not prepared to back it, then maybe the lender shouldn't either. So personal guarantees are the norm. Particularly if there's a portfolio, that will also require a lot more work. So a limited company where perhaps you've got other properties held in your personal name, some properties held in different SPVs, bearing in mind that some lenders prefer a single SPV for every property. Others are happy to have more than one property in the same SPV. So there's quite a lot of variation there, and which lenders are going to be most appropriate for a particular borrower will depend on a variety of factors. But it's another thing to take into account before deciding on which lender to use.
Indeed, and again, this is where one of the advantages of working with a broker like John Charcol, because you guys, you know all the lenders, you know all the criteria, and you can make sure that you fit the client to the appropriate lender. What advice would you give to landlords in terms of preparing for sort of limited company finance, should they be getting documentation together in advance and perhaps putting their portfolio into a spreadsheet, those kind of things?
Well, I think whether the property is held by a limited company or a personal name, if you've got a portfolio in particular, then having all the detail in a spreadsheet is really helpful, particularly if there's more than four or more mortgage properties, because lenders now have to assess the whole portfolio. We find a lot of our clients do have a spreadsheet, and the key things to have in that spreadsheet will be purchase price, current estimated value, which you can do on a computer-based model, of course, rental income, mortgage amount, and the mortgage interest. If one can provide a spreadsheet with that basic information, that will be enough for most lenders. And there are some lenders who will accept documentation from the client in whatever format it's produced, as long as it gives the right information. Others need it in their format. In fact, the majority still do. But I think in terms of lenders trying to encourage brokers to work with them, we will see more lenders being more flexible in terms of how they'll accept the information.
And I guess to finish, we're going to see more lenders coming into this space, so rates may become more competitive. So all in all, for landlords that are incorporating or incorporated, there's going to be more choice going forward.
I think from the mortgage point of view, that's absolutely right. It's a chicken and egg situation from lenders. When there's not much business, there's less incentive for lenders to get involved. The more business there's going to be, the more incentive there is. But I would strongly advise everybody, when they're thinking of incorporating, to have a conversation with their accountant or the tax advisor first, because there's lots of things to consider. The mortgage is an important one, but there's lots of other considerations as well. And what's right for one person may not be right for somebody else.
Absolutely. Well, again, very good advice there. So we've been talking about limited company mortgages, and if you have any requirements in this area, please do get in touch with our finance partner, John Charcol. We'll put the links and the phone number below this video, and there's the team here of brokers ready to assist with any finance requirements you may have. So thank you very much again for joining me, Ray.
Pleasure.